going to shift gears a little bit and talk more of a case study. I'm going to be cautious as I do this here because the company we're talking about is a company called Neutral Tandem. And let me be clear, the companies that I own in Tarpon, they're not really by any means sexy, high growth, hot stocks. Almost. I own CarMax. For a long time we owned Discovery Channel. Google's in there. A handful of companies that are fairly Lowe's companies, as in Lowe's hardware stores we own. Berkshire Hathaway we recently bought about a month ago. So most of the companies in there are decidedly non-sexy, non-tech. Neutral Tandem, I'm throwing it out there for a couple reasons, but I want to warn you that it may not be in your circle of competence. I feel like it's in mine because I spent those years in telecom. I was a project manager. I was dealing on a daily basis with a problem that Neutral Tandem actually ended up solving. So yes, yeah. So I feel like, and again, I guess I'm a little unusual in a value investor, and again, I was just writing this to somebody the other day. I feel like if I have a curse, it's that I'm a value investor and my circle of competence includes some technologies and telecommunications. Telecom just attracts irrational people. It always has, it always will. Most of the time that's a negative. Sometimes it can be a positive though because it gets irrational on the other side as well. Yes, go ahead. Yeah, our largest holding right now is about 10% of the portfolio. Anywhere from 10%. I don't want to really own anything that's under 5%. I will on occasion because the value fluctuates. But somewhere, we're making focused, concentrated bets. So we own 15 companies total right now. The largest is 10%. There's a handful. Berkshire Hathaway is one. Original position was 8%. It's gone up since then. So it's a distinct difference from a mutual fund. If you have a 2.5% position in a mutual fund, that's large. So it's much more focused in the other direction. Yes, yep, you could. I don't. There's a calculus involved in terms of how much I weight the portfolios. Basically depends on what I think they're worth, what the market thinks they're worth, and the confidence I have in the ultimate valuation. Berkshire was 6 weeks ago it was a slam dunk, and we've been doing well because of that. So.
You brought up the Class A or Class B?
Class B shares. Yep, Class B. Actually, as an aside, it was a. I'm not sure how many people follow Berkshire, but Berkshire Hathaway is Warren Buffett's holding company. For a long time, and about a month ago, I met with all of my investors and was eating crow a little bit because even as far as last September, they were wondering, why don't we own Berkshire? You're such a big Buffett fan. And I said, well, there's just other opportunities out there, and I don't know that we ever really would own Berkshire. Yet here I was buying it 6 weeks ago. It was a little bit of a special situation. Number one, the valuation is very compelling. Berkshire, at that time, 6 weeks ago, was just about the cheapest I'd ever seen relative to its own intrinsic value. There was a sort of a technical reason as well. Berkshire is buying a big railroad company called Burlington Northern. In order to effect that transaction, Berkshire had to split one of the classes of their stock, the B shares. It didn't take a genius, and I only say this because I figured it out. It didn't take a genius that when Burlington Northern came out of the S&P 500 index, everybody know what the S&P 500 index is? Okay. Burlington Northern's got to come out. Something else has got to come in. To date, Berkshire, despite being one of the largest companies that otherwise would have been in that index, hasn't been simply because their A shares are really priced too high. Point being that problem was solved, and Berkshire, you could reasonably guess, was going to be the next one that went into the S&P 500. That would mean that there would be really forced buying by a lot of big institutions, a lot of the funds that do nothing else but track the S&P. They have to buy just so their portfolios mirror the index. Long story short is, between the combination of all those things, finally got off the fence. One of our other companies, Discovery Channel, had actually hit its estimate of intrinsic value. It's time to sell it anyways. And sometimes it's better to be lucky than good. About 4 hours after I finished buying Berkshire shares for all of our investors, the announcement came out, yeah, Berkshire's going to be in the S&P 500, and it's probably gone up 17–18% in the month or something like that. So again, I sound like a trader when I say that, and it was not my intent at all, but it happened to be right time, right place. And one of the other reasons that I'm going to talk about Neutral Tandem, though, is this. I thought this was fairly compelling. Their CEO is actually an alum. He went to right here, NJIT. So I thought if I couldn't convince you to be a value investor, then at least I could provide some inspiration to keep working on the engineering side and eventually be like Ryan Wren and have your own venture capital backed company and take it public and all that. So Very sharp guy. Their company is actually based in Chicago, but I thought that might hold a little bit more relevance in terms of talking about neutral tandem. There are risks in owning neutral tandem. I'll talk about some of them in a little bit. One of the risks, though, is that they have a limited operational history. Been public for about 4 years. I'm sorry, been public for about 3 years. They have about 4 years of operational history behind them. I otherwise wouldn't really have much to do with a company that only had that much of a record, other than the moat that it's creating, which I'll talk more about in a second. That aside, the question I would pose is, everybody can, I just put this up here so people could see the fluctuation in stock price over the last couple years at least. And again, they went public the end of in 2007, but the value stayed around that $20 mark for a while. Knowing nothing about the company, other than it continued to perform well, does it make sense that at that particular point in time, shares are trading about $14 a share, and maybe about a year or so later, they almost doubled to almost, well, 34, 35. If your car were valued in a similar way, would you start to think that maybe it was just a little bit silly? If your car, if somebody walked up to you one day and said, I'll give you $5,000 for your car, 9 months later came up to you and said, I'll give you $10,000 for your car, my point here is just, you know, that fluctuation in stock price can be an opportunity if you're paying attention to things. And you can substitute anything. Would a house's value change this much? This is before the bubble, obviously. Would the value of any other asset trade as much or fluctuate as much as a stock price? I don't know that it would. And while that could be for valid reasons, I think a lot of times it's simply because everyone's so focused on the minute-to-minute market that it's a very emotional-driven decision. By the way, I guess started to get interested in neutral tandem right around the $20 level, right around here, simply on a valuation basis. Again, been keeping an eye on them for a little while, but honestly wasn't sure they'd ever be cheap enough to be of interest to me. And the only reason I really knew them, again, is because having been a project manager, being very familiar with the problem they're solving, they were sort of on my radar screen. They weren't even on my watch list, to be candid with you. I have a more formal watch list that I track a lot of companies on, just because I didn't know that they'd ever be in the wheelhouse. But so got interested then around here. Actually started buying around here, and you know, I've continued to buy and seem to have bottomed, at least for the time being. And the point is, you know, even at 20 bucks a share, I felt like it was a steal. Plan to hold it for years, so I'm okay with it, with averaging down. In terms of, you know, the initial thought process that went on into neutral tandem, it's similar to any other company we're going to add to the portfolio. So typically, I'm looking at things that are temporarily out of favor. So the stock charts, I don't pay much attention to stock charts. You know, where we want to be buying, in theory, is as the price is falling, as the price is reaching the bottom. So that's oftentimes a first screen to say, is it going to be of interest? I will, if I hear of a company, haven't heard of it before, excuse me, a lot of times that's one of the first things I check. The chart, again, not to get any divine meaning out of it, but just to see how it's trading. If something is, it doesn't really matter to me how unequivocally cheap it might be or the prospects. I just have a hard time buying something that's not near its 52-week low or it's not on the way down. Just it doesn't really make a lot of sense sometimes, but and I can prove to myself that even after a 50% rise, something is still valued very low. But I just, it's one of those silly things that, you know, I don't want to do. So, you know, in my head, this is sort of the high level. Is this company that I've heard about worth following up on? Is it worth looking harder? Is it worth digging down a little bit? And if you can meet those 4 criteria, then typically it's worth spending, you know, a morning reading the annual report, trying to figure out what you can do. And it's important to point out too, most investing decisions, I feel like they're going to go in one of 3 piles. It's either going to be a no. Most things I look at are no, just not happening. Some will make it to a watch list. It's a great company, but just not the right price. That'll stay on the watch list for years, it could be. A very small percentage of those investments are yes, they make their way in the portfolio, but a large percent of them too are just too hard. You know, they just go in the too hard pile. A lot of the banks I've been looking at lately, in my head, they're still in the too hard pile. Analytically and I guess emotionally, I want to and have been looking at a lot of banks, a lot of regional banks lately, just because that should be where the value is. But for some accounting-related reasons, related to loan modification particularly, I'm just not doing it yet. They're still in the too hard pile. So everything is coming out of here. Neutral tandem, though, is just one that that seemed to fit. It met those three criteria. Is worth a closer look. And again, I feel like it's inside my circle. Don't go out buying, small telco stocks because KL came and said, "Oh, this is a great place to be." It's not exactly what I'm trying to do. To some extent, they could be selling Swiss cheese as far as the purposes of this next few slides are. But it is probably important to understand that this is the quote from the company. They provide tandem interconnection services to competitive carriers. Don't even worry about that part of it. Again, I'm not going to get into the business of the company per se. But one way to think about them as is owning the rotaries or the roundabouts that internet traffic goes on. This is highly simplified, and for the engineers in the crowd, if you want to have a further discussion, happy to do it. But for the time being, let's just think of it like that, and I'll tell you that they are attractive because they're solving two problems. When it comes to telecommunications, for traffic to pass from one network to another network, there's got to be a connection, right? The problem is that if you directly connect it, if Sprint connected their network right to T-Mobile, number one, it'd be hugely expensive. Number two, it'd be ridiculously manual because of all the different connections along the network. The point is that Neutral Tandem offers a solution that involves no direct connection, and more to the point, they are neutral. Let me back up and give you a little bit of the industry color. When I was a project manager a dozen years ago, it was myself and two teams of network engineers would be working around the clock really just to be able to connect different networks. I would provision circuits, which mean one of the customers would call, big telco, want to connect to somebody else, and it would take 2 weeks and 12 people just to get that connection done. The reason that it was so problematic is because they would have to connect through the old Ma Bell companies, who these small carriers would also compete with. And it kind of makes sense when you step back and think about it. And telecom is often bizarro land, but the reality is a lot of these small companies, they've got to work with their biggest competitors just to get things done. Neutral Tandem, my point is, allows a lot of the non-Ma Bell companies, I wouldn't even say smaller companies, but the non-Ma Bell ones, to be able to connect better, cheaper, faster, and to some extent it's been a no-brainer for a lot of these folks to sign up with them. I'll leave it at that for now, and again, I can talk about it in detail if we need to, but it's not really that relevant to the valuation part of stuff. I'm also ignoring, about a month ago, not even 3 weeks ago, the company came out. They are starting a brand new business essentially that has a lot of strategic fit with their current business. I didn't try to value or model any of that in here, so everything that I'm talking about is sort of already built in the shares. This is one of my key points about risk, and I'll let you read that for a second. If you are investing in small telecommunications companies, there's just several givens. Every once in a while, there's going to be market panic about what the Verizons or the AT&Ts of the world do. Just going to come with the territory if you're owning shares long enough. There's also going to be a lot of hemming and hawing about the arrival one day of an all IP-based network, all internet protocol. That would be a threat to Neutral Tandem, should it ever happen, but we've been talking about that for 20 years. VoIP is also a potential risk, but the point is that I'm comfortable with this. You may not be, and that's okay. That's sort of the point. To your question about valuation, though, this is sort of the heart of it, and this is a fairly simplified discounted cash flow analysis. At the end of the day, every company is worth whatever the current value of all its future cash flows are discounted back in today's terms. Does that make sense? Everybody knows that getting $1 today is worth more than getting $1 a year from now because you can invest it and earn more on it. Same thing, but in reverse when you talk about discounted cash flows. I'll probably just, maybe I should just send you this whole thing when I'm done. So if people want to get in the weeds on it, you can, I can send you this file and I'll put some notes in there so you can figure it out and monkey around with it for the purpose of the class. But in general, this is one way to figure out how to value a company. And Buffett's whole thing is just that. The value is the cash that you can pull out of the business from now until the cows come home. And long story short, this is one way with fairly conservative inputs to come up with a value for Neutral Tandem. I apologize, that's a little blurry. But it could be, my estimate is, it's worth over $30 a share, and about a week or so ago it was trading at close to 16. So that's built on a lot of assumptions, as you might guess. A discounted cash flow it's a hint, it's not an answer. I would not bet everything that the value was 35 and not 30 or maybe 40. But the point is that there's a hint, and it's probably going to be around their range, just taking emotion out of it, just looking at what the cash flows can do. And this is, again, a fairly conservative assumptions going into it. Having said all that, I will tell you that the DCF, and if you haven't learned about it already, you will as you get more into finance and investing. Yeah, terminal value is a way to estimate the value of the cash flows of the company beyond what you're modeling. So basically from year 10 out, from 10 to infinity, you can just assume, in this case, I'm assuming that the growth rate is going to be 3% a year at that point. The company's not going to, eventually, it just can't grow any faster than GDP could. And GDP grows at 3% a year. And a terminal value, anything other than 3% in my mind is, it's almost indefensible.
Meaning as the returns diminish, what would eventually be equal?
Yeah, basically the cash flow. What we're doing here is saying the first 10 years, we're going to take that, all the cash flows the next 10 years, give that a number. Then we're going to say all the cash flows from beyond year 10 to infinity, give that a number. Add those two together. I also add in shareholders' equity sometimes, another discussion. But basically those two numbers tell you what the, on the cash flow basis, what the value of the firm is. So this is just the math to discount all that back in today's terms.
Okay.
Yes?
How do you come up with a future cash flows?
That's all just formula driven. The key inputs, again, are owner earnings. And owner earnings is something that Buffett has talked about. Basically take the company's net income, adjust it for cash, non-cash transactions, and then also subtract out the capital expenditures that are required to just maintain the existing network. So that initial owner earnings is sort of the hard data. Everything else is just based on, the formula. It's just a plug and chug sort of thing. So you can get a sense, I think. I think you're getting a sense of it's sensitive to the inputs, obviously, and that's my whole point. Yeah, it's much better to be conservative, obviously, and than to not and find yourself surprised if something happens.